Well, that looks better than the one I put together. Thanks, Carlos.
So you're welcome. Just make it easier for everybody.
I think so. It does. It does make it better for everybody else. I like that background. Yeah, just add something, say the background I've got going. It says CB on it, blue colors.
Looks like he's in a totally different
It
room.
doesn't?
No, I didn't make it. Somebody else made it.
Yeah.
And shared it with us.
Yeah, come on in. How are you, Neetu? Good morning. Good, thanks.
How's your open house?
It's good. There's not too much traffic.
No.
It's been really quiet. But you just need one, right?
That's right. It only takes one. Just tell our sellers, it only takes one buyer. Don't lose that buyer. Good morning. How are you?
I think I might just stay in my office, so it doesn't get too crowded in here.
Okay. Probably gonna be 30 or 40 people in here. I heard that need to. Rich must be dreaming, huh?
Good morning.
John Barris, how are you today?
Well, I like your background.
Isn't that nice?
Classy.
Yes, and that is, if you go to the company Facebook page, it's available for everybody.
Then it'll look like we're all meeting in the same place again.
Yeah. Or maybe tell your clients that you actually work at Coldwell Banker, right? That's the whole idea. Let them know, what do I do?
Oh, I think they know what I do. Marriage counseling, financial counseling, divorce counseling.
Divorce counseling.
Is Sarah gonna speak?
Yeah, Sarah, I know I didn't ask you, but are you prepared to talk about rates today?
Hey, Rich. Yeah, I can give a little update.
Okay, great. So we've got about 2 minutes and we'll begin then. John, getting excited about the wedding? Did he lock up?
It looks like he did.
Yeah, it's either that or he just took a picture of himself, right? And that's his background screen.
Hi, Richard. Hi, everybody.
Good morning. How are you, Carmenza?
How are you?
Good.
I don't see you.
You don't see me.
Hey, the background is good. Can you share it for everybody? That's a cool one.
Isn't that nice? It's available for you and you only, Carmenza.
Thank you.
I will say that.
I will use it, by the way. That was a cool one.
It is. It is. Who knows? Everybody might start using it.
Is it free for everybody in the works or?
Yeah, everybody else has to pay for it, but it's free for you.
No, I thought that it was in the CV marketing thing.
No, it's not. It's not.
Very cool, by the way.
Thank you. Thank you. I like it too. Did John Barris log back on? No, it doesn't look like it. There he is. John, you're live again, I see.
Yeah, I'm having some internet. Must be the cooler weather we're having.
What is it, 95 degrees?
Hey, we haven't hit 100 in a week and we had to see it for another week. So we're in the 80s. Actually, We are cooler than you guys are.
Really? Well, that's nice. That's nice.
You know, in Irvine and Newport, we're getting in the 90, 94. We were at like 85.
That's so unusual. Highly unusual.
But a bit more humidity than we're used to.
Yeah, all of us are. Well, good morning, everybody. It's good to see you. Thanks for attending today. So we're going to begin today's presentation with Sarah Menchaca from Southern California Funding. Sarah, how are you today?
Good, how are you?
Good, thank you. Give us some good news, Sarah.
Well, I can start off with some good news. Everyone may have heard by now, but the conforming loan limit is going to be raised to 715,000. So we do have lenders accepting those new loan limits, which is, an increase from 647,200. Bad news though, rates are up. Yeah, news came out today that they're still expecting the Fed to raise the rates by 75 basis points next week. Inflation increased instead of decreasing as they were initially hoping. So rates today, conforming loan limit, this is based on 75% loan to value, a 760 credit score. You're looking at a range of 5.375 to 5.75 today, with 0 to 1 points being charged. High balance conforming. So for Orange County, that's 970,800. Again, same scenario, 75% loan to value, 760 credit score. You're looking at a range of 5.625 to 5.999. And then your jumbo loans are ranging between 5.75 to 5.875.
Actually, that's better than I expected.
Yeah, they've gone up about a point since my last, I think on August 23rd was the last time I gave a rate update, but yeah, that's where they are today.
Okay, well, thank you, Sarah. Anyone have any questions for Sarah? And the bond market took a beating today. The whole stock market is taking a beating today. Yields are increasing, so not very good news for us, as a matter of fact. But of course, inflation is running rampant. That's why. Maybe someday it'll be under control. Well, Sarah, thank you very much. So today's discussion outlines the basic rules for payment of capital gains tax, with emphasis on the capital gains exclusion for a person selling their primary residence. So a few things with the Tax Cuts and Jobs Act that passed in December 2017 that did not change. That exemption did not change, nor did long-term capital gains rates, the recapture rates, and I'll talk about that also, nor even the rules pertaining to a 1031 tax-free exchange for real property held for investment. Now, 1031 exchanges for personal property was eliminated. So, but for real property, it has not changed. So Carlos, if you put up the first exhibit. So what I thought I'd do, I've got a few different exhibits, and the very first exhibit shows the tax rate for short-term capital gains. So if you don't hold a property in excess of 1 year, this is the tax rate that you could expect to incur when selling real estate, stocks, bonds, so on and so forth. Now the categories are broken down into single taxpayers, married filing jointly, separately, head of household. And the numbers you see represent adjusted gross income. So you can see how dramatic the tax rate is for an individual who does not hold a capital asset for at least 1 year and sells it within that time frame. And we know typically the tax rate on capital gains themselves, it's either 0, 15, or 20%. So let's just take a look at this. So let's say, for example, your adjusted gross income falls between $83,550 and $178,150 for a married couple filing jointly. The tax on the short-term capital gain is going to be 22% of the gain. And you can see how it just escalates dramatically. So it's something to keep in mind in regards to tax planning. And also, if you have clients who are giving consideration to disposing or selling real estate because they've made a lot of money in a short period of time, I would suggest that you allow them to know that tax consequences are going to be severe. And this is only one aspect of the tax consequences that you may encounter when selling a capital asset. So Carlos, if we can go to the next slide, please. So I know you've memorized all of the tax rates I just showed you, right, on the prior screen, but just look at the comparison. And I used 22% before, and that was about income between $83,000 to $178,000. Look at the tax rate if we use, if our adjusted gross income for a single taxpayer is between $41,675 and $459,750. We're only paying 15%. Likewise, if my adjusted gross income for married couples filing jointly is 15%, if my adjusted gross income falls between $83,350 and $517,200. So in determining which tax bracket or rate you fall into, the net income from investment income is included in this calculation. So keep that in mind. And now, so we know how much tax we could be paying there. And then one other tax that maybe we forget, and if you go to the next slide, please, is net investment income tax. So in the event you have net investment income, and that could be comprised of interest, dividends, capital gains, rental and royalty income, non-qualified annuities, income from businesses involved in trading of financial instruments or commodities, and business that are passive activities to the taxpayer. So what could a passive activity to a taxpayer be? They could possibly own and rent property if they're not engaged in the real estate industry. That is deemed to be a passive activity. So now we talked about short-term capital gains tax rates. We talked about long-term capital gains tax rates. In addition to that, if a taxpayer's adjusted gross income meets one of the thresholds, and you can see if the filing status is for a single taxpayer, if their adjusted gross income is more than $200,000, they're going to pay an additional 3.8% tax on the net investment income. So the taxes mount quickly. So if we're fortunate enough to fall into the 15% long-term capital gains tax rate, and then unfortunately, we've exceeded the threshold as shown below here, there's an additional 3.8% theoretically on any net investment income. Add to that California tax, which is probably going to range between 10 to 13%, probably paying 31 to 32% tax on the gain for the sale of our property, for example. And then it's exponentially worse if we do not hold a property for at least 12 months. So questions that come up often, people want to, this is probably more often with families, grandparents or parents want to sell or give a property to a dependent. And now they're thinking, well, I want to just give this to them. Well, unfortunately, the tax consequences can be exceptionally severe because the recipient of that gift, their cost basis in their property is going to be equal to the donor's cost basis in the property. So if grandparents bought the property 25 years ago, property is worth $2 million today, and they bought it for $50,000, the recipient's tax basis is going to be $50,000. So if we sell it for $2 million and my cost basis is $50,000, I'm going to have taxable income of $1,950,000. So there are better ways of doing it. Make sure grandparents die and and bequeath the property to their beneficiaries. That is the best form of tax planning anybody could encounter, as a matter of fact. And I just had another example. Those are numbers that I just used, are real numbers on a question that somebody posed to me yesterday. So what I said was actually, well, grandparents don't want to keep this property because it's a rental property. So they would have a gain of about $1,950,000. I said, tell them to 1031 the property and then have the granddaughter move into the property. And then in the estate planning of the grandparents, have that property dedicated specifically to the granddaughter. So now when grandparents pass away, granddaughter gets a step up in basis equal to the market value as of the date of death. And let's just assume it just happens to be $2 million. So if granddaughter sells that property, she has no taxable gain on the sale of that property. Not that we're tax planners, but those are things that give consideration to when you have questions coming up. And other times we have people want to say, well, I just want to grant deed the property to them so they can have it. I don't know why we want to do that thing. They're very generous people. It's very nice, but it doesn't make sense financially. And in my example of $50,000 and $2 million, the tax liability if the property were just sold would be about $600,000 in that transaction. Substantial. It's a lot of money to give up, especially to give to the government, right? We'll use that to reduce inflation. So capital gains, what's the holding period for long-term capital gains? More than 12 months. If you don't hold it for at least 12 months, you're subject to short-term capital gains tax rates. And then we know what long-term capital gains tax rates are. Carlos, if you could go back to the prior slide, please. 0%, 15%, or 20%. So realistically, if a married couple finally jointly has adjusted gross income of $83,350 or less, any capital gains that they experience would be taxed at 0%. A really pretty good tax planning. So what could you do? You could possibly defer income. But remember, the capital gains themselves are going to be included in this number, the $83,350, so they very well could surpass that level. However, but maybe there's ways to defer income that would allow you to minimize the gain or the tax on the gain of any type of a sale. And then another tax that comes into place in investment property, and there's nothing on the slide here, is depreciation recapture. So in owning a property, of course, what do we want to do? We want to minimize our tax liability, especially this is investment property. So we depreciate the structure. Land is not depreciable. However, when selling the property and assuming there's a gain on the property, depreciation that's recovered in the sale, and generally it is subject to a 25% tax. So if I had a property that was worth $500,000 and I depreciated it down to $250,000 when I sell it, I'm going to be paying tax of 25% of the $250,000 in depreciation expense that I took against that property. And remember, if you're so smart and you decide I'm not going to put myself in that position, the IRS is going to impose that anyways, and they're going to calculate the taxes if you did take the depreciation. So you can't avoid that, as a matter of fact. So another tax to give consideration to, and these are all good reasons why when you have clients who have investment properties and they want to sell, 1031 exchange is really the best. So there's two solutions: die or a 1031 exchange to avoid taxation. So did someone have a question? No?
What about adding someone to title?
Well, that theoretically is a transfer of an interest. So it's taxable. So if you add somebody to title, people think they're just going to go down to the recorder's office and record a grant deed. However, the assessor is going to, and the county recorder is going to ask for a preliminary change of ownership report, which is now going to be the basis of a sale theoretically. But if you do, then that person, the recipient, their basis is going to be equal to the grantor's basis in the property. So it doesn't eliminate any taxation. And sometimes people want to do things like that. They want to transfer their entire interest to a recipient because the current owner of the property is a non-resident alien, and they're hoping to avoid withholding tax upon the sale of the property. But they can't avoid it because if they transfer it to somebody else, that's a sale. And it's the buyer who has responsibility for withholding and remitting the tax, both from a federal standpoint and from the franchise tax board. So yes, the seller may avoid it, but the buyer is the one who has responsibility for withholding and remitting the tax in the event the seller is a non-resident alien.
So if you're single and then you have you have a gain of 500,000, and then the third year you decide to get married, so can you still take the 500,000 as a deduction?
Well, I'm going to address that. That's a good question, as a matter of fact. So she was asking, Shweta was asking, and she must have gone through this herself. She's single, she bought a property, and she and now she married somebody, and now there's a $500,000 gain. Is that what we're saying? $500,000 gain? Can she take advantage of the $500,000 exclusion? Sure. If there's the test. And so you must have owned the property for 2 out of the last 5 years. You both must have used the property for 2 out of the last 5 years also.
Be married for 2 years.
No, you don't have to be
2
married
out of the 5 years.
for 2 out of the 5 years. So the person who married you would have had to have occupied that property for 2 out of the last 5 years, although it's not necessary that they are on title.
They don't have to do that.
They don't have to be on title, correct?
Richard, I have a question.
What's that?
If you were to inherit the property from, say, a grandparent, and your cost basis, you're saying it would go up to the grandparent's date of death,
Correct.
is there a time frame of when you have to sell that to continue, or can you continually utilize that? If you waited 30 years, can you still go back to grandma's death? In
Yes,
2020?
you can wait 30 years,
Okay.
so there's no time frame.
Okay.
Can you show the short term real quick?
Sure. Would you do that, Carlos?
Would it be ideal to get an appraisal at the time?
Yes, at some point in time near the date of death, so it's accurate.
The short term means less than
12 months or less. Correct. 12 months or less from the date of acquisition through the date of close of escrow. So it's a substantial penalty. Well, thanks, Mary.
The video is that one.
Yes. You should make one of people coming on and off the title,
Yeah,
which I get at least 5 or 6 calls a week. And they don't want to listen, they don't want to go and, talk to their CPA.
don't want to spend a
They-
few $100s, right,
Right,
to save
right.
thousands of dollars.
Right, or just create a trust. No,
Yeah.
I'm just gonna give the property to my son. I
Yeah.
owned it for 30 years. Okay, go ahead.
Go ahead. Doesn't help anyone.
Hopefully it'll fund my social security when
Yeah.
I retire. All the taxes.
So what I didn't necessarily address is what happens if I sell my principal residence. Individuals are generally permitted to exclude from income up to $250,000, and it's a $500,000 exclusion for married couples filing a joint return realized on the sale or exchange of their principal residence. Okay, and you see when you look at different forms, you'll see section 121. That's exactly what we're referring to. Internal Revenue Code section 121. Can you use the exclusion more than once? Yes, generally you can, but only once every 2 years. So to qualify, you must have owned and used the property as your principal residence for 2 of the years during the 5-year preceding period on the date of the sale or exchange. And remember, the 2-year time frame does not need to be continuous. So obviously the ownership period must be at least continuous, but the use period doesn't have to be continuous. Other questions that come up still, and so I've talked about this in the past. Can I use an exclusion in connection with Internal Revenue Service Code section 1034, which is rollover of gain on the sale of a principal residence if I purchase a home of equal or greater value? And a 1034 rollover for a principal residence, the analogy would be a 1031 exchange on investment property. Well, the 1034 rollover gain was removed from the code years and years ago, so it is not available to a taxpayer. So you can't roll over a primary residence to another primary residence and avoid gain, or the recognition of gain. Can I still, and previously there was a $125,000 gain exclusion for individuals age 55 years or older, and that also is no longer available. However, if you previously used a $125,000 exclusion of gain, are you prohibited from using the current $250,000 or $500,000 exclusion of gain. Generally no, just as long as you meet the requirements, and that means the ownership and use requirement of 2 years during the last 5 years. And then just to confirm, how does the exclusion apply to married couples? Well, the $500,000 exclusion applies to married couples filing jointly when all the following conditions are met. Either spouse meets the ownership requirement, so 2 years during the 5-year period ending on the date of the sale of the exchange. Both spouses meet the use requirement, once again, 2 years during the 5-year period on the date of the sale or exchange. And neither spouse has had a sale of their principal residence in the preceding 2 years in which they took advantage of the exclusion. So what happens if I'm married someone who has used the exclusion within the 2 years prior to our marriage? Well, one of the two spouses would be entitled to a $250,000 exclusion. You could take advantage of the full $500,000 exclusion if more than 2 years lapses from the date of sale of the former residence upon which the exclusion was used. So now, if my spouse dies, must I sell our principal residence within a year of my spouse's death to take advantage of the $500,000 exclusion from gain? Well, no, the exclusion is permitted to be used the full $500,000 within a 2-year time frame following the date of death. But it's predicated upon, once again, the ownership and use requirements and the fact that you haven't used the exclusion the prior 2 years. So obviously no one gets any time for the date. Even if you keep the body in the house for a year after the fact, you're not going to get any benefit associated with that, right?
How do you know?
You see the inside of my house, right? Another question, so what if I move before I have occupied my residence for 2 years or before 2 years have elapsed since the last time I sold or exchanged my principal residence? Well, if you fail to meet either the 2-year requirement, you could still be entitled to a pro rata exclusion as long as the failure to meet the requirements is because the sale or exchange is by a reason of a change in place of employment, health, or other foreseen circumstances. So, and the act provides that this ratio is that portion of the $250,000 or $500,000 exclusion equal, and I'll explain this, to the fraction of the 2 years that the ownership and use requirement is met. So an unmarried taxpayer owns and uses the principal residence for 1 year and then sells because of a job transfer may exclude up to $125,000 of gain, 1/2 of the regular $250,000 exclusion. So Carlos, I have an example there. Thank you. Sorry if I'm reading this, but I'm going to. Ms. Seller purchased and occupied her principal residence in 2018. 1 year later, she's transferred by her employer to another city and sells her house for $100,000 gain because she occupied a residence for 1/2 of the required 2 years. Ms. Seller is entitled to exclude up to 1/2 of the $250,000 exclusion otherwise allowed, thereby covering her entire gain. Previously, you were only able to exclude the pro rata portion of the gain, but that has changed. So there's still some benefit. And then, of course, there's further clarifications to the permissible reasons for sale or exchange allowing a pro rata exclusion to exist. So for example, that let's say the regulations provide that a sale or exchange is by a reason of a change in employment, health, or unforeseen circumstances only if the primary reason for the sale or exchange is a change in place of employment, health, or unforeseen circumstances, not just because it's incidental. So just keep that in mind. And if you meet the requirements, then you're entitled to the safe harbors, meaning you should be exempt from any repercussions associated with regulatory liability. So place of employment, there are guidelines. It's deemed to be a change of employment if the primary reasons for the sale or exchange is a change in location, blah, 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 of a qualified individual's place of employment. So the safe harbor provides that the change of employment occurs during the period of the taxpayer's ownership and use of the property as the taxpayer's principal residence, and the individual's new place of employment is at least 50 miles further from the residence sold or exchanged than was the former place of employment. So I moved and now I'm changing employers, and it's because it's more than a 50-mile difference. So now I'm entitled to the pro rata portion of the exclusion. Well, if the person never had a job, well, the distance between the individual's new place of employment and the residence sold or exchanged is at least 50 miles. You're entitled to the pro rata exclusion. And then employment includes, or change of employment includes starting a new job. It could be continuing employment with the same employer, for example, relocation, or starting or continuing a self-employment. So there can be valid reasons. Health. So if your physician states you must move for health reasons, that's great, because you think it might benefit you. That's not a valid reason, as a matter of fact. So if it's something in which you're required to assist somebody with their medical condition, that could be a valid reason, because you're now a caretaker for your mom or dad. And then unforeseen circumstances, we see freeways being widened. So what if I bought a house today, but of course the listing agent never notified me that this was subject to condemnation, and now the state of California bought my property because they're widening the road there, and it occurred before 2-year time frame lapse, I'm entitled to a pro rata portion of the exclusion.
We have a question.
How we do?
Yeah, Ella is asking, does exclusion from capital gains of 250,000 stand the same if a property has 2 unmarried owners?
Yeah, it's a married couple. It's a married couple in regards, well, the 250,000, typically what I would expect to see is that one person is going to be entitled to the exclusion in her example. You'd have to make a decision.
Want to paper, scissors, huh?
That'd be worth getting married for.
No. It might be, I don't know, it could be more expensive. And then, can I deduct the loss on the sale of my principal residence? No, you cannot deduct the loss on the sale of a principal residence. And then what if I have gains from the sale of my principal residence above the 250,000 or $500,000 exclusion? Well, ideally, if you've owned the property for more than 12 months, you're entitled to the more favorable capital or long-term capital gains tax rates for the amounts in excess of the exclusion. And then other special rules and exceptions, taxpayer can elect to not have the exclusion applied to a sale or exchange. And then if an individual is required to reside in a nursing home, that theoretically could count as time of occupancy associated with the property. And then an individual whose spouse is deceased on the date of the sale of the property can include the period the deceased spouse owned and used the property before death. So you can see if you allow two years to lapse, it could make it more difficult to qualify for the exclusion. And we're assuming that this is in the event of death. And then this is a good one, actually. An individual is treated as using the property as his or her principal residence during any period of ownership, while the individual spouse or former spouse is granted use of the property under a divorce or separation instrument. So let's assume somebody moves out and the court mandated that one of the two spouses move out during divorce proceedings. That's entitled, they're entitled to, that's included as occupancy for the spouse that left the property. Yeah, yeah. And then what happens if I transfer my principal residence into a revocable trust? Well, if the grantor of the trust is the same individual who is the beneficiary of the trust, it is not deemed to be a taxable transaction. So it's excluded and there is no gain recognized on the sale. And of course, that's predicated upon the fact that the owner previously who owned the property as individual and the trust themselves still treat that as the principal residence. And the 2 of 5 years time frame still applies.
Example.
You and your husband transfer your primary residence into your revocable trust. It is not a taxable event. But let's say that your husband's now deceased and you decide to create a trust, and there's another beneficiary to that trust, that very well could defeat that because now there's somebody else who has an ownership interest in that property.
We have another question, Rich, from Jeff. What if you borrowed most of your equity and then immediately paid it right back? Could you take the money borrowed towards your cost basis?
Loans have nothing to do with the description. This is simply the matter of the gain. So yeah, whether or not you borrow money or don't borrow money doesn't come into the equation. It's not considered to be a cost of the transaction itself. So it wouldn't have any effect. So Jeff, feel free to pay your loan off. That doesn't have a loan. Can I utilize an Internal Revenue Code section 1031 like-kind exchange in connection with an owner-occupied property? No, you can't do that, but there are some tax planning aspects that you might give consideration to. So sometimes individuals will exchange one rental property for another with the plan to move into the acquired property after living it. And then of course, after living, they want to sell and take advantage of the full exclusion. Well, that it's still available to you. However, if you sell a property, that's an investment property, acquire an investment property, and then occupy that as your primary residence, you must not only meet the 2 of 5 year test, but in this specific case, you must have owned the property for at least 5 years from the date of the sale or the close of escrow on the exchange. So you must, on that investment property, down leg property or replacement property, you must own it for at least 5 years to take advantage of the $250,000 or $500,000 exclusion. And then of course, the other question is, if I do sell an investment property and I acquire a replacement property, that's an investment property, and I qualified for a 1031 exchange, I want to move into it right away. Well, you can probably defeat your 1031 exchange by moving into it immediately. You should at least rent that property for 1 year, and it's recommended that the rental be for 1 calendar year. So when you file your tax return, the IRS can look at that and say, oh, they actually did. The intent was not to occupy it. As it's going to be the substance of the transaction that they're going to look at if it's going to be contested. So minimum 1 year, and ideally rent it for 1 year, 1 full year, 1 calendar year.
So like if you bought the other one in November, the 1031 property, you should at least rent that till December of 2023 before.
Yes. And ideally, you're going to wait till January 1st before you convert it to a primary
So like,
residence.
if you bought it in like February of next year, you have to wait till when we do the calendar year.
Yeah, I'm just suggesting that the risk is greater of them defeating the 1031 exchange. And this is just what's recommended. It is not a part of the code that you must rent it for 1 calendar year. It just seems to be the recommendation to avoid them overturning your 1031 exchange, which could be very costly. But
Richard,
yes.
I have a question. I just want to make sure I understood correctly what you said before. You said that if you exchange a rental property to another rental property, rent it for a year, then move in for at least 5 years, then you can get the full exclusion?
No, you must occupy it for 2 of that 5 year time frame, but you must own it for 5 years.
No, I mean, even, okay, so you exchange it, you rent it for a year,
Right.
then you move in for
2 years.
2 years. And if you own it, after you own it for 5 years, you're entitled for the full exclusion?
You're entitled to the exclusion, but that's a very good question, as a matter of fact. And And that's something I wanted that I'm going to be addressing right now, as a matter of fact, is yes, you're entitled to the exclusion, but the exclusion based upon something entitled qualified and non-qualified use can be diminished, as a matter of fact. And your example is a perfect example. So I'll address that first. And some of my examples are going to be repetitive of what your question was. But in her example, we're just going to make an assumption that we sold an investment property, we acquired a replacement property, we rented it for a year, moved in for 2 years, then I rented it for 2 more years after that. And by the end, so now I've owned it for 5 years and I'm selling it. So unfortunately, the period of time in which you don't occupy the property is deemed to be non-qualified time. So it's going to reduce the amount of the exclusion that's available to you. However, any time following the period of occupancy within that 5-year time frame is deemed to be, even though typically you're not occupying it, is deemed to be non-qualified. There's an exception to the exception. So those 2 years, the final years, 4 and 5 in her example, are now deemed to be qualified because they fell within the 5-year time frame and it followed the time frame in which I occupy the property. So in that example, I would be entitled to 4/5 of the exclusion. Now, let's assume that 4/5, just for simplicity, of a $500,000 gain is $400,000. The $400,000, and we're going to make the further assumption that the property was owned by a married couple, falls below the $500,000 exclusion, you'd be entitled to a $400,000 exclusion in that example.
And it doesn't matter how many years you held the first rental property before the exchange?
No bearing on it. None. Correct.
Okay.
It is. It is a great tool. You lose a portion of it, but then keep in mind, even if you, in your example, what, you know, the other tax implication you're going to face is going to be depreciation recapture. So there's really no way to avoid that, unfortunately, but it's a great way to shield a lot of money if you really want to sell the property and you don't want to be forced into rolling it into another investment property.
Thank you.
Sure. So Carlos, if you could go to my first example. Great. Make sure I've got the same thing on my screen. A married couple finally jointly purchased a vacation property. And now these rules apply not only to investment property, but to second homes. So keep that in mind. So a couple purchased a vacation property January 2009, which they sell on January 2nd, 2017 for a gain of $600,000. During the last 2 years of ownership, they occupied the property as their principal residence. They would divide 2 years of qualified use, which is the time they occupied the property, divided by the total years of ownership, and multiply that fraction times the gain of $600,000, which yields $150,000. And the $150,000 exclusion falls below the total exclusion available of $500,000. So they could exclude $150,000 from gain, and yet they would be taxed on $450,000. So the first 6 years of ownership are deemed to be non-qualified use. Which means you're not eligible to take advantage of the capital gains exclusion. Qualified use is represented by the time at which the couple occupy the property. You're gonna raise your hand, Mary?
I wonder, is it possible for someone to use the vacation home and sell it as an investment property? Can you do a 1031 exchange, even if it wasn't continually rented, whether it's an Airbnb or let's say you used it 2 months out of the year?
Yeah, but I think there are, as long as, you know, in regards to a vacation property, and theoretically, if you're renting it out, your usage can't exceed, I think, just like a couple of weeks out of the
Okay,
year,
so
which is
there's
the
a
dilemma.
time frame.
There is a time frame, which it
Okay.
now is deemed to be an investment property as opposed to a second home.
Okay.
So remember, the exempt, we talked about this just briefly, but qualified use is the time frame in which I occupy the property. Non-qualified use is the time frame in which I didn't occupy the property. And we're talking about an investment property. So the exemption from non-qualified use would be the time following my occupancy within the preceding 5 years. So if I bought the property, and we'll just simplify it, in the very first year, I occupied it for 2 years, and then the following 3 years, it was rented out. Those following 3 years are an exception, and it's no longer deemed to be non-qualified property. So in that example, I could take the full $500,000 exclusion. That help? But if I bought it and I didn't occupy it for the time frame in which I've been renting it out, it is deemed to be non-qualified. And remember, to take advantage of the capital gains exclusion in any case whatsoever, you still have to meet the 2 of 5 year test. You must have occupied that property for 2 out of the last 5 years.
So the difference is if you purchase it as a primary residence versus an investment property, right?
Yes, yes. But still, the 2 and 5 year test always is applicable once you convert a rental property or investment property to a primary residence. You can only take advantage of it if you occupied it for 2 out of the last 5 years. And once again, if you rolled an investment property to an investment property and converted it to a primary residence, you must have owned it for at least 5 years before taking advantage of the exclusion.
So this vacation rental, even if you've been staying there the last 3 years for like 1 month, 2 months out of the year, you still cannot use that as a qualified use. Even though you're moving into it just the last 2 years, like as a primary residence.
Well, the dilemma with the vacation property, it's not a primary residence. You're not entitled to the exclusion, and you can't roll it into an investment property suddenly to avoid the gain. That's the dilemma. Let's say next example 2. So you don't have to remember all this, but the whole point of the different examples I'm going through is if you do speak to a client and they're giving consideration to sell an investment property, roll it into another investment property, and they want to eventually occupy that, yes, they're entitled to use a good portion of the exclusion, but a $250,000 or $500,000 exclusion, but it may not all be completely available to them. So we just want them to be aware, so they speak to their tax planner so they understand that I'm not going to get the full $500,000 exclusion most likely. So this just happens to be the same taxpayers. So January 2009, married taxpayers finally joint return buy a house and use their principal residence for the first 2 years. They then convert the residence to a rental for the next 3, after which they sell the residence and realize gain of $600,000. None of the 3 years of otherwise non-qualified use after the initial use as a principal residence would be used to reduce the capital gains exclusion. So they're entitled to the full $500,000 exclusion. Now they have a gain of $600,000, but they're only going to pay tax on $100,000. So $600,000 minus the $500,000. And this gets back to a discussion we had at a prior meeting. This is a great way for people to take advantage of the exclusion. If you buy the property, you live in it for at least 2 years, you can rent it for 3 years, and you can exclude up to $500,000 in gain. So if I do it every 5 years, I can take advantage of a $500,000 exclusion. But if I hold a property for 20 years, and the gain every 5 years is $500,000, my total gains $2 million, I am only entitled to a $500,000 exclusion. Yeah, it's a lot of work, but it could be something to share with people. So let's go on to the next example, please, Carlos. So the same couple buys a house in January 2009 and rents it out for the first 3 years. They then convert it to their principal residence for the next 2. Following this, they once again rent the residence out, this time for 3 years, after which they sell the residence for a $600,000 gain. They own the property for a total of 8 years. They have 3 years of non-qualified use, the initial 3 years, right? And the 5 years of qualified use, which is equal to the 2-year qualifying period which they occupied it, plus the remaining 3 years of the 5-year ownership period up to the close of sale. So they have 3 years of non-qualified use and 5 years of qualified use. So they're actually entitled to 5/8 of the exclusion of $500,000. So if we just do the math, we can multiply the gain times 5/8, which is $375,000, and it falls below 500,000, the cap of the exclusion. So they could exclude from income $375,000. See a pattern here? The same couple buys a house in January 2009. What is special about 2009? That's when the law changed and owner occupied use was deemed to be non-qualified use. That's why 2009 is prevalent in this discussion. Before that, it didn't matter. They changed the rules. So the same couple buys a house in January 2009 and rents it out for 6 years. They occupy it as their principal residence for 2 years and sell it for a $600,000 gain. So the same pattern, the initial years of occupancy are non-qualified use. And they only have 2 years of qualified use. So the formula is a $600,000 gain times 2, which is the years of qualified use, divided by 8, the total years of ownership. So they could exclude $240,000 from the gain, and they'd be paying tax on $360,000 plus depreciation recapture. And one last example, and this is prevalent. Donna lived at her property as a primary residence beginning 2008 and 2012. She received a new opportunity across the country, but decided she didn't want to sell the property. So she occupied the property for the first 4 years. And then she rented the property. Now in 2014, she wishes to sell the property. So she lived in it for 4, rented it for 2, ownership years totaling 6. Even though there would have been 2 years of otherwise non-qualifying use as a rental, Donna does not have to count non-qualifying use that occurred after she lived in the property as a primary residence. As a result, all gains will be treated as qualifying and eligible for the capital gains exclusion, except to the extent of any depreciation recapture. So even though Donna does not still live in a house as a primary residence, she has still used it as a primary residence in at least 2 of the past 5 years. That's the other test, right? As she lived there in 2010 and 2011 before renting it in 2012. So the section 121 exclusion is available. And this is where it's very interesting. And we had an example, I think, in our office a year ago. It's notable that if Donna waits until 2016 to sell, at that point, there will be 4 years of rental use and only 1 year use as a primary residence. So remember, the other portion of the test is during the last 5 years, you must have owned and occupied the property for 2 out of those 5 years to gain the opportunity to use the exclusion. But if she waited 1 more year, her occupancy during those last 5 years would have only been 1 year, thus 4 years of ownership of which she didn't occupy it. She would not be entitled to use any of the exclusion in that example. So timing is very critical. We had an example, a couple moved back into their property. So in the time frame, they let too much time go, or they rented it out again. It defeated the exclusion, or at least it was so close, they may have lost the availability of the exclusion. And then so don't forget depreciation recapture, 25% of the total depreciation taken, assuming you have a gain on the property. And then net investment income. Unfortunately, you can be subject to paying an additional 3.8% on any net investment income if you exceed certain thresholds associated with adjusted gross income. So that's the presentation for today. Do we have any other questions? Okay, even questions up there. Thank you. Carlos thought of everything. Let me see anything in the chat box. Nothing in the chat box. Okay. Well, hey, Sarah, thank you so much. I appreciate for your presentation earlier today. Everyone that attended, thank you so much for attending, and we'll see you next week.
Thank you, Richard. Have a good day.
You're welcome.
Richard, that was fantastic.
Thank
I
you.
know this is when you should be serving mimosas after this presentation.
You know, because he wants you guys to all.
Thank you, bye.
And have an entire marketing